how many of you know about Crosscut Ventures? Okay, small subset. So maybe a little context might help, and then we can take it wherever you guys want to go. I am just here to sort of answer questions and be as candid as I can be on things. Crosscut Ventures. We started this fund back in 2008. Rick Smith and myself are two of the three co-founders. Our third partner is Brett Brewer. He was the founder of Intermix Media, which owned MySpace, sold it off to News Corp for $700 gazillion, and kind of got the flywheel spinning here in LA on early stage tech. Rick and I were at a firm called Palomar Ventures. It was enterprise IT focused in a market that had no enterprise IT. And so what we started to see in the 05, 06, 07 timeframe was a lot of entrepreneurial activity, second and third time entrepreneurs starting their next ventures with no local venture dollars there to support them. We were getting frustrated chasing deals in Silicon Valley where we had no proprietary edge or angle. Investing is hard and you need some sort of brand, some sort of leg up to actually find the best deals. Otherwise, your returns end up being pretty modest. So the idea was, at that time, there was no company building capital of LA, and we felt like we had kind of the right background to go do it, and maybe a little bit of the street cred from Brett's work as an entrepreneur and some of the stuff I've done to pull that off. Fast forward, Fund 1 was a $5 million fund raised in 2008. Fund 2 was a $16 million fund raised in 2012. And then just this past June, we announced a $75 million fund, Crosscut 3. We now have institutional capital. And so it was sort of a major milestone for us. And I've been told by many people in this town, a major milestone for the town to have kind of a real established seed stage fund in the market. There are many more coming. We have a lot of colleagues here in town that are raising capital, which I think is all good for the ecosystem. And at the end of the day, the truth is we are only here because the entrepreneurs within Southern California are building real businesses that create value, and thus the institutional money that gave us the capital believes that we might be a conduit to more of that. So it's not for anything we've done, it's more for what's happened here in Southern California that has attracted the interest around institutional money. All that said, we think we've built a pretty good product. We have three partners that are all ex-entrepreneurs, myself, Clinton Foy, and Brett. I've done stuff in e-commerce and social, public company turnarounds. Clinton ran all US operations for a large Japanese game publisher named Square Enix. Brett's background was both MySpace, but then he went off and did it again for a company in Kansas City called Ad Knowledge, scaled that from 12 to 300 million in revenue in the ad tech sector. The gray-haired guy on top, we call him the Silver Fox. He is 25 years of transactional experience, everything from private equity all the way down to early stage investing. And he's a generalist with a really good kind of inner stomach for business judgment. So that's the four managing directors of the fund. We have an associate named Joe Gazelle, who's running around here, that came out of Corp Dev at Intuit. So we've got a lot of good ties. We spent a lot of time in Silicon Valley. And then we've got this sort of roster of entrepreneurs that are invested in the fund and play an active role with us to help us vet and advise and work with early stage businesses. Again, 80% of our portfolio is in Southern California, 20% is opportunistic in Silicon Valley and New York. So net, we have a $75 million fund. We are about 10 deals into that fund, lots of dry powder, and very excited about what's happening in Southern California. Now, I could literally stop right there because this is, again, I'm not sure, there's maybe 5 people in this room that have interest in this topic. There we go, great.
Thus far, what are you looking at?
So if I look at the new fund, I can rattle the companies off. So we invested behind Richard Wolpert, who started HelloTech, on-demand technical support services to the home. We incubated a next-generation Shopify Magento e-commerce platform called Reaction Commerce. They just went live in beta. We funded Vulcan out of the Bay Area, which is esports fantasy. So if you think of FanDuel and DraftKings, this is the esports equivalent. So you can buy fantasy teams on League of Legends and bet real money in how those championship titles play out. That company's a rocket ship right now. I can't even fathom what's happening there. We did a subscription commerce business called Candy Club. Pretty simple business, 3 pounds of candy in a box delivered to your door, $19.99 a month. It is literally gone from, I think we invested at about 2,000 monthly subs. They're at 12,000 subs in 6 months. Incredibly efficient customer acquisition on Facebook. No offense, but kind of the Midwest housewife target has done very well for us. And so that business is growing. We have, let's see, what else do we have in there? We incubated a company on our second floor of our office in Venice called Little Labs. They are an app dev studio for the smartwatch platform, for the Apple Watch and Android platform, doing a lot of licensing deals. I have a title coming out in 2 weeks around The Martian, the movie that's in the movie theaters now. So a blend. When people ask us what Crosscut invests in, my answer is usually everything that LA is good at, and that is getting more and more diverse by the year. Right? So our first fund was very e-commerce and ad tech heavy because back in 2008, the internet ecosystem of LA was built off of the monetization of the web, Shopzilla, Lower My Bills, Price Grabber, Overture, and it was built off of some of the fast manufacturing capabilities of downtown LA, things that have stemmed off the Korean Marts and Forever 21's apparel manufacturing capabilities. So we had a lot of stuff there. Now, we're looking at drone control plane technologies. We're looking at SaaS businesses that are being sold to the small to medium businesses. We're seeing one of our successful companies in Fund 2 is called Data Science. Data Science is a service. They have 50 data scientists sitting somewhere cranking on algorithms and numbers on behalf of Fortune 500 customers. And every data scientist in the country wants to work for them. So it's become a very diverse and unique marketplace, which is very exciting. And then our bent is let's find opportunities where we actually think we can help and we know something about the businesses, and so that it's more than just capital that we're bringing. We're actually bringing relationships, et cetera, that will help accelerate the business. And when I define our job is to, and this is maybe where this topic comes in, our job is to find a great opportunity, a great entrepreneur, and sit down and really define the milestones that will attract additional capital. And I think that is a nuance that's lost in good markets. In good markets, syndicates and rounds come together and they're not terribly thoughtful about what needs to be achieved. And we live in this world right now where we think things are going to implode at some point. And so we think through, hey, you think those are the milestones. It's actually probably the next hill you have to get to. And how do you build a syndicate and a financing strategy that will support all the variability you're going to see? Because inevitably, every plan you put forward is going to be wrong. Right? There's only one in 50 deals that Crosscut has done. There's only been one entrepreneur that has executed against plan and actually exceeded plan, and it's Brian Lee from Shoedazzle and now again at Honest. Right? So that's just the nature of this beast. Okay, so yes, questions, love it. I would really rather do Q&A than walk through these slides, but if you don't ask me questions, I will force you to listen to these slides. So it's on you.
So I am an entrepreneur, and I have a patent idea, and it's about education. It's an educational tool for toddlers to preschoolers to teach them alphabet. And I am really a creative person, and I would need someone like Approach Strategies to just get me to that next step. I already have samples, I already have all my goods and stuff of that nature, okay. But I'm getting ready to go online as well. Okay. So is there anything, since you mentioned Forever 21, is there other like clothing? Because these are, my line is for toddlers to 2 years old.
Yeah.
Well, 3 years.
Yeah, so I'll try to turn that into a question and try to see if there's some help that I can provide, right? So if I understood it, you have product concept, you have prototypes, you think you have a business that can be built off of that goes beyond a single collection, you have a point of view on a market and a perspective as a designer, and the question is how do you get that to market, how do you bring it to scale? Fair? Okay, yeah, so we see a lot of ideas like this, and I think you're right. I think you need to build out a team. I think you need a support staff around you. An entrepreneur of one or a business of one is very difficult. It's very difficult to get funded. Capital for something like this usually comes in the form of a friends and family round, people that believe in you and are willing to give you that first chunk of cash to get the product to market. And in this case, whether it's an online e-commerce store that you build on a Shopify platform, or whether it's a wholesale distribution deal with some toddler retailer that loves your collection, that's what you should be trying to accomplish, right? Get some validation. You need someone besides yourself to tell you that your idea is genius, right? Certainly a viable path to building a company, usually not a path to a venture capital backed business, because they rarely drive big equity value. And again, the game of venture is about finding something young and immature, but with enough proof points to not make you think you're crazy, and getting conviction as the investor to put capital behind it, to hit that inflection point in the hockey stick, because then we, who are not very smart, venture capitalists, look like geniuses when you end up on the other side of that inflection point. And we're all low self-esteem guys that need all the validation we can get that we're doing the right thing, right? So think about that when you're pitching them, and try to tap into that inner psyche and lack of confidence that we all sit with, because we're all in a very tough business, meeting hundreds of companies a month and selecting 8 deals a year, right? We go out and say we see about 3,000, 3,500 business plans a year that come through our door, and we invest in 8 companies, right? And we're gonna miss some. We always do, right?
So I'm another one of the low self-esteem venture capitalists.
Nice.
I work in almost exactly the same field as you. So when you guys are syndicating a deal, what are your thoughts on giving preferential treatment to the first check-in, or the first $1 million, the first $2 million? Do you see any sort of like preferential syndication happening?
So usually your pro rata rights are secured if you've done it right? If the original money is being managed and run with a professional mindset, they will negotiate pro rata rights to make sure they can protect their ownership in the next round. And we have never actually, we've never been big enough, nor do we have egos that would ever take us to the point where we'd be like, screw the little guy, we're gonna crush you and take the whole round. That's just not how we work. So there's always room, right?
I guess I'm talking more about the first check, when you're raising the next round. Have you seen in a syndicate style deal where one investor will get a better valuation or higher price because they wrote the first check?
No, not kosher, not cool, not supported. Andrew.
So as an entrepreneur, when you're raising money, you frown upon entrepreneurs saying, hey, we're raising $2 million, 500,000, get better cash, better discount off the cap.
So I'm negotiating a deal right now where I'm asking for that, but I would never let it happen to us. if you want the real answer, and I'll tell you why. The round that I'm negotiating is a strategic set of investors. It's not traditional venture capitalists. It's not institutional money. At the end of the day, we are only as good as our reputation, and everybody knows everybody in this town. And so could I look at that other investor, if we're both sitting on the board, and know that I got in at a cheaper price? If we both came in and took the exact same risk, I probably couldn't. In this particular case, the argument I'm making is that the strategic cares less about financial return and is doing it for more strategic reasons, and thus the valuation they place on the business is actually not market. And so we're the only institutional money at the table, and it's kind of this negotiation of like, hey, if you want our money, it has to come at these terms. Otherwise, this deal is too rich for our blood. Right? So the nuance there, like I couldn't look at a high quality venture capital fund who's writing a check alongside of me and say, I get in at a 4, you get in at a 6. If they're smart, they would never allow it. And I also don't think I could ask for it.
I get that. So what kind of preferences would you want for a lead, or do you
No, there are no preferences for lead. I mean, the terms for that round are the terms for that round, in my opinion. Everybody gets the exact same deal. And oftentimes, the truth is my fiduciary responsibility as the board member representing the preferred stock, I am representing everybody. Whether you wrote a $50K check or $1 million check, my job is to make sure I'm protecting the preferred stockholders. And so to do something that's more self-serving to me wouldn't be the right way to go about it. Back room.
How can universities work to partner with VCs?
Which university are you aligned with?
USC.
So you guys are doing a fantastic job. I've been investing in Southern California tech since 2001. When I got here, I started spending a lot of time at Caltech. Then I stopped spending time at Caltech. Then I started spending a lot of time at UCLA. Then I stopped spending time at UCLA. And now I spend a lot of time at USC. And I share that story because it shows the progression and maturation of the tech transfer divisions within those universities. And SC is doing it right, and most of the others have not been able to get out of their own way. So keep doing whatever you're doing. To me, you just have to be able to free the IP out of the university with no strings attached except for some equity stake that goes to the benefit of the endowment or the department. That to me would be the perfect model. There are different models that exist all over the place, but the idea that you own the IP just because you were there in the university, I get it. I understand everything that led to that dynamic. But if you want to stimulate innovation, which is what we should all be focused on here in Southern California, right? Every entrepreneurial program, every university, every accelerator, every incubator needs to care about nothing else except building successful, scalable businesses in the Southern California ecosystem, because that drives job creation, which drives more innovation, which drives economic growth. That's my point of view. Okay, other questions, or I'm going to dive into syndicating deals. There we go, Andrew, thank you. Yes, save us all.
Hang on.
So, what do you think about AngelList and those kinds of syndications where at first it was sort of your buddies sort of recommending companies on AngelList? You could all see them and go like, yeah, that's cool, I'll do that with you. And now it's, hey, that's cool, I'm taking 25% out of your butt.
Yeah, so the best person to ask that question to is Paige, and I'll invite Paige up on stage to answer it. Mm-hmm. And honestly, it's perfect timing, right? Because Paige is a cowboy, and I think he knows that's a compliment. And he came into this market. I've been here forever. I'm old and stodgy. He's young and fresh. And he looked at AngelList and said, yeah, I can do something here. I can take advantage of this. And I think we, in a kind of old school venture framework, we're like, ugh, oof. That makes me nervous. And this idea that you're just going to share it around with a bunch of people, and all these people who are not doing this full time are going to drop checks around it. So we've been pretty scared of crowdfunding as a blanket statement, and pretty nervous about what we think will be some of the backlash that will come when things go to shit, and they will. And so we've been very hesitant. So we have not been active on any of those. But we have presence on those platforms. We certainly support and represent our portfolios in that way, but we have never used them as a source of deal flow. We've never invested in an AngelList syndicate. It's just not been our cup of tea. Paige has a totally different perspective on this. And so if you'd like to quickly take my mic.
I'm speaking after you.
I know. Well, but is everyone going to stick around on this? Because he's talking about this topic, right? Kind of? Or do you want to just answer this question real quick?
No,
You-
I'm only interested on my top. Are you done?
No,
Yeah.
I don't think so. Am I done?
Well, it was technically it was till 2:10, but
Yeah. No, I wasn't trying to say I was done. I was just going to give you an opportunity to chime in. Because
I'm gonna
well, no, it's actually 2:15.
Oh,
Yeah. Time flies when you're having fun. Yeah.
all right. Here are the rest of my slides. Syndicate deals, don't party round, be transparent, low ego, be wary of signaling issues. And then I was just putting this up here because most people come and ask me about raising a fund. I just finished raising a fund, and it took us several years off my life. And this would be my advice on actually raising capital. So if you are a venture capitalist and you're trying to raise capital to do this at scale, these are my 5 bullet points of advice. I'm available for any other questions. And thank you for not forcing me to go through these slides.